Welcome to another episode of Map Your Money. We're about 4 episodes in of me doing a jingle to introduce you, Jeff, and I think I'm out.
Oh, gosh. What will the mappers do without your jingle?
I know. I think I might just need to improve my creativity. So
yeah, you're really falling off on the creativity, man.
Without cable, I don't see all these insurance jingles all the time. You know, they're not in the back of my mind. But I guess all these streaming platforms are adding ads too, so
yeah,
guess I'm still getting them.
No, that's a rule in the Cone household, is we do not do ads on the streaming platforms.
No, yeah.
Ain't no way.
I love it. Well, that's kind of the icebreaker I had today was movie related. So I can kick it off since I'll be kind of putting you on the spot. But what's a movie that is highly rated or well liked that you think is overrated? If you don't have anything that comes to mind, I can kick us off. So I have a big one.
I feel like there's a couple of movies that some people like that I really can't get behind. Like one of them that comes to mind is like Wedding Crashers. Like people love the movie Wedding Crashers? But like whatever, like it just like doesn't grab me. Like sometimes like the Vince Vaughn style of comedy, like he's kind of the same character over and over, and like sometimes he's like, okay, dude, like you're mean, we get it. Is that kind of the whole joke? So maybe I would say that's like one for me, Wedding Crashers.
That's a good one. I feel like that's really well liked. I like that movie. I kind of feel the same way with I feel like comedic actors can definitely be polarizing, like Will Ferrell. I feel like you either love him or you hate him. My answer was Pulp Fiction. I never really gotten behind the hype on Pulp Fiction.
Really?
Yeah, I like other Tarantino movies, but
see, like Reservoir Dogs, I thought was not very entertaining, but Pulp Fiction to me, it just keeps going. You know, it's like just random stuff keeps popping up that kind of drags you. And now it gets pretty rough. You know, it can be tough to watch, but okay, well,
maybe I need to rewatch it. It's been a while. I also don't like Dunkirk. Have you seen Dunkirk?
Didn't we watch that together in Utah?
Maybe.
I feel like that. I feel like maybe we worked that.
No, we watched some.
We watched Greyhound for sure. We watched Greyhound, but I thought we watched that one too. Yeah, I mean Dunkirk is okay, man. I like a lot of the war movies. I think they're good.
I'm a big Nolan fan, so anytime he has something I don't love, it's I guess it stands out, but. I don't know. I just like dialogue, and there's maybe 10 words in that whole movie. So
yeah, I mean, I will say that it seems like now that the streaming platforms are just kind of puking up all kinds of content, that the movies lately are just kind of so shallow and a little corny and kind of predictable. And so I would say movies of late, I would put them all in that category.
Yeah. When was the last time you went to the movie theater?
Let's see. My parents got me a gift card to go to the AMC, and Sam and I used it a year and a half later, and that might have been a year and a half ago. And I think we still have a different unused AMC gift card that is sitting by my toaster in my kitchen that's been there for a year. So does that answer your question?
Yeah, it's been a while.
Hey man, comfy couch, dogs, nice
it's
TV at home.
It's hard to beat. And once a movie comes out in the movies, you can wait 2 weeks almost, and then you can buy it at home. So
yeah, it used to be you had to wait 3-4 months to get it on DVD. We would always go. Growing up, there was this movie theater in Springfield, Missouri, that would show movies that were about to go on DVD the next week, but you can go see them in theater one last time for $2. So that was we would go catch a lot of them that way.
That's cool. I know they're doing reruns of very popular movies in the IMAX and different things, but I've never done that. Older movies.
Yeah, they need to bring back some Star Wars or something. That'd be sweet.
Yeah, that'd be cool.
Yeah, I remember my first IMAX was Saving Private Ryan. I was 4 years old.
Oh wow,
that was scarring.
Nice. That'd be a good IMAX, but well, cool. We have a good episode today talking about the economy mainly, what's going on. With markets, economy, and just kind of updates there across the board. So let's jump into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only.
All right, Jeff. So talking about the economy today, I know it's been a little bit while since we've kind of gone through and spent a full episode on it. So wanna give you your shine. What's top of mind for you? What have you been watching and seeing, and what do you think is most relevant right now?
Yeah. I think it's good to kind of circle back to the economy. Certainly, we've been getting some questions from clients about, hey, what's going on? Should I be worried? It seems like things are slowing down. Another question that we get a lot is, aren't things pretty expensive right now? Aren't valuations high in markets? Should we be worried about that? So, I think number one is we still have to take a step back. As much as we hate thinking back to COVID, you still have to include that within your analysis of our current economy, because we are still working off some of the remnants of COVID. Some of that is inflation, which still has not gone down to 2%. Some of that was, the very low amount of labor supply and how everybody was kind of clamoring to get labor and then hoarding labor for a while. And we're still seeing the effects of that. And then also, government spending and the deficit, which really has not, come back down, and then actually has been met with higher interest rates and higher debt servicing costs. Right. So there's still a lot of things within the economy right now that you can kind of see are related to the COVID area, but we're actually starting to see quite a bit of trend change in that post-COVID, the economy was very strong. A lot of people had a lot of money. There was low interest rates for a while, and then interest rates went up. But even in 2022, 2023, while a lot of people were expecting recession, including myself, it never really happened, right? And it never really materialized. And in fact, growth was actually revised up from the 5-year forecast back in 2022. That really was characterized by really high wage growth because there was low labor supply. Employment markets were very strong. Asset markets and the stock market started to they bottomed in October of 2022 and started to rebound from there. And a lot of things were actually, kicking into gear and going pretty well, including inflation, which basically peaked in the middle of 2022 at around 6%. If you look at the core PCE that the Fed uses, and it was, heading down pretty neatly to 2 up until it stopped at around 2.5, right? If you look at where we are now, a lot of those things have changed. Consumer spending has really started to slow down. If you look at the contribution to GDP growth, consumer spending is usually one of the main factors. That's not only just the biggest share of the GDP pie, but also if you break out what components of GDP are contributing to growth year over year, 60 to 70% of that is consumer spending. That's really started to slow down this year. We're also seeing manufacturing has really slowed down. Manufacturing has been weak for several years, but it's actually gotten worse over the past, let's call it 12 months. And you look at some of the sub indices like the new orders index or the employment index, and you start to see some weakness there. And then employment too. Employment growth has really slowed down. Unemployment right now is at 4.3%. That's the unemployment rate. That's up from, the mid threes that was back in, let me get it here, 2022 and 2023. And then, of course, it went into the low fours in 2024. And now what we're seeing is the 3-month average of new monthly jobs added is only 29,000. And that's down from about, 150,000 in 2024. So, you are starting to see those signs where there's some cracks forming. Of course, there's a lot of questions about, is this a labor supply issue? Of course, immigration has not contributed to labor force growth. And of course, actually the labor force has been flat for all of 2025, but the number of unemployed people is up by 500,000. So, I do think there's some things going on where it's like, okay, new labor supply certainly is low. We wouldn't expect a lot of job growth, but we're also not absorbing all the new entrants into the labor market like we were. And of course, what would you expect to see on top of that? Okay, maybe you would expect to see wage growth coming down because demand for labor is coming down. Maybe you would start to see job openings start to come down and layoffs start to tick up. And we are seeing all of those things as well. Layoffs are certainly not high right now, but job openings for a while, there was 2 job openings for every unemployed person, and now that's below 1. So really we are seeing some things that there are some signs of weakening. There's certainly some signs of slowing, but GDP growth is growing at 2% right now year over year, and a lot of that is because of AI investment, CapEx investment, and some of that is kind of offsetting some of the weakness. And even right now, In Q3, I think we're tracking for around 3% growth. So, definitely some things that are changing and some trends that are changing under the surface, but still the economy is growing, and a lot of that is related to this AI investment cycle. And of course, the question is, how much can this continue? How much additional investments do we expect to be made there?
Yeah, as far as what we're seeing with the slowing, perhaps, of different areas of the economy, consumer spending, you mentioned manufacturing, some parts of labor. Would you say there's a particular catalyst that you think has kind of led to this? Is it just the higher interest rates that we've been in for a while? Is it just the nature of the business cycle? We've been running hot since that period in 2022 that now it's time for a revision, maybe a combination of the two. Anything else that you're kind of seeing?
Yeah, I mean, I think it's part of that cycle. We went from a lot of people spending a lot and, kind of spending above average. And then so you would expect the economy kind of revert to the mean and that growth rate to revert to the mean and go down. I mean, you're also seeing, back when in 2021, 2022, there was this huge shortage of labor, and we actually saw the lowest quintiles of wage earners see the fastest wage growth. And of course, their propensity to consume is much higher than a higher income quintile person. So propensity to consume, think about you just made an additional $10 today. You didn't think you were going to make that money, but you just did. What percentage of that do you spend? If you're a low income person, you probably spend close to 100% of it. You're spending a lot of your money on necessities, and there's so many other things that you can buy if you have extra money, versus high income people are not typically spending a high proportion of that. We've really seen that changed. Low wage earners are not seeing the fastest wage growth anymore. That's actually flipped now to some of the higher wage earners, especially in some of the services indices, which are doing so much better than manufacturing, especially amid all the tariffs. So, you see wage growth start to come down, especially in that cohort. You're going to see issues. We've also, we've seen student loan repayments restart, and I think that's hitting the consumer a little bit. And then just in general, things have gotten weaker. Income growth has come down, and there has been a lot of spending over the last 3-4 years related to COVID, where people bulked up on a lot of goods and housing things, and then they were shutting their house, and then COVID, we got vaccines and everything opened up, and people went and bought airline tickets, and they went to hotels and restaurants and shows, and you kind of expect that to kind of normalize and even out. And I think we are seeing that. And I think what's promising to me is we're not really seeing that drop off a cliff. We're seeing that kind of come down and flatten out. So I think that's good, at least, right? Like the trend is not a terrible trend lower. It's just maybe a resetting.
Yeah, no, that definitely makes sense. I know you mentioned in there student loan repayment kind of restarting. What have we seen kind of with delinquency rates? Has that changed at all in this new environment? Is that starting to increase?
Yeah, I mean, delinquency rates on pretty much all consumer loans are increasing right now. It's really getting a lot of people's attention. But what I think is really interesting is, you look at a snapshot of a chart and you see a delinquency rate moving up. It's really helpful to go to the last 5 years, last 10 years, last 20 years and look at that chart. And what we see is that delinquency rates did this in 08, 09, right? And they really rose, and they were at some kind of level and they really rose, and then they came back down. And now delinquency rates are kind of moving back up to the normal before COVID, and actually lower than that 08, 09 level, lower than the level going into 08, 09, whenever, before it spiked. And so, yes, we do have, right. Yeah. So we do have higher delinquency, but we're also leveling out at a delinquency rate that's very manageable by banks. They have losses that they take to kind of estimate what losses they expect, and that gives them a little bit of cushion if losses happen. But overall, delinquency rates are not back to those levels we saw then. They're kind of just moving back to higher okay levels. Does that make sense? It's not. But student loans, I think, is student loans and auto loans really stand out. Auto loans are kind of the exception there, where they're going above the average. But student loans, I mean, you saw them for a while. They were at zero because they turned the payments off. As soon as the payments were turned back on, they jumped, quite a bit. And so, yeah, we are definitely seeing some delinquencies there. We're also seeing just some kind of cracks in the credit market. It's just like the stock market, the credit market also has a very high valuation. Instead of measuring it on like a price to earnings ratio, we would measure it based on what's the additional yield I'm getting relative to treasuries for taking this additional credit risk. And that additional yield that you get, called the credit spread, is basically at its lowest level in history. And so if you want to take credit risk, you're getting paid the least amount for it, right? And so as soon as you, in that kind of market environment, just like equities, you're priced to perfection. And so as we are starting to see some more, delinquencies rising, we're seeing the economy slow down a bit, and now we're starting to see defaults in the syndicated loan market. You do have some people kind of worried about those issues. Now, from what I've heard from portfolio managers and CLO managers that had exposure to this, the exposure was, widely held but manageable. And so far, I think the important thing is it looks like these incidents with First Brands and Tricolor are isolated incidents, and that they were, fraudulent essentially, and maybe not really indicative of a slowing economy causing the default.
Sure. I know a hot topic in kind of the finance world recently has been that private credit market. Did you want to kind of touch on that and explain what that is and where we're kind of at with that?
Yeah, I mean, so used to, when I was a bank examiner in 2014, they called this the shadow banking market. Remember that term, shadow banking?
I've never heard that. Yeah.
Oh, okay. Well, there you go, making me feel old. So shadow banking, right, was kind of like this opaque market, funding market, where businesses, small businesses, or sometimes they call them middle market businesses, they need a loan, but maybe a bank determines they're too risky for the bank to make that loan because the regulators are coming in and the bank has to provision against the losses. They have to do all these things. And so you have this kind of opaque market where you have this group of investors that say, hey, we have $100 million to lend you. We'll lend it to you. And we're going to do it not at the 6% in the high yield market, but we're doing it at 8 or 9% in the private loan market. And so you have these, kind of bilateral debt deals and negotiated deals, which is different than a syndicated loan market where you have a bunch of different banks coming in and sharing the credit risk. What's been happening is that as banks have been less willing to take credit risk, less willing to lend, especially like commercial and industrial C&I type loans, a lot more of that funding focus has gone to the private credit markets and the shadow banking. Now, that's not bad per se. It's really important that we have functioning capital markets and functioning funding systems, but you want to make sure there's, collateral and covenants and protections, and, that you have confidence in the ability of the borrower to repay both principal and interest. And so what's happened is all of that market has gotten a lot of attention because of the yields. And so what happens when returns are good and yields are good? People pump a lot of money into that asset class. So you have a lot of new funds popping up. I tell you, I get a call about, 2 or 3 different private credit funds a week for the past 2 years. Usually that's kind of a warning sign to me. And they're trying to invest all this money, and you get to a point where you have, $500 billion of loans trying to get made and $1 trillion sitting on the sideline. So how do you invest the other half a trillion? How do you invest the other 500 billion? Well, you make concessions on the loan. You'll take a lower yield, or you'll take a lower collateral position, or you'll be junior, or what have you. And so you do have these things happening where you just kind of feel this willingness to take additional risk and this assumption that automatically is going to result in higher returns. And that's usually the dynamic that can start to get really tricky and risky in markets. And so what happened in Tricolor and in the other one, First Brands, is essentially They issued a bunch of loans in debt against assets. For First Brands, it was like trade receivables, and for Tricolor, it was actual vehicles. And they essentially either over collateralized or the underlying asset did not exist. Which sometimes in First Brands' case, they borrowed let's say $2 billion against a trade receivable because they're going to get $2 billion from their customer, but then that $2 billion just didn't exist. There was no receivable there. And then, a similar thing happened with Tricolor, kind of using the same VIN number car as collateral for multiple loans. And so there's not enough protection for all of it. So, that's what we've seen. And that happens with markets. I think people need to remember markets go through booms and busts, and they go through euphoric periods. They go through, depressing periods. And we have to kind of be in tune with that as we understand markets too. A good investment needs a good story and a good price. And I think right now that's something that a lot of people need to be cognizant of, is there's a lot of stories in the market right now, and there's not really a lot of good prices.
Yeah, I know that's another important point is talking about valuation. We've had a really good run in the market. You mentioned 2022, where we had depressed prices in equity markets and bond markets. But since then, it's been a boom cycle. 2023 was really good, 24, and here now year to date, 25, all double digit returns when we look at the S&P 500, for example. what are we seeing, or what are you seeing in valuation, kind of across different markets where maybe there's opportunity? Is everything really expensive? What are kind of your thoughts on all of that?
Yeah, if you look at there's all kinds of different valuation measures you can look at, but essentially, forward PE, that is what's the price I'm paying for the expected next year's earnings. And that's important because it incorporates earnings growth in there instead of just using a trailing PE. But of course, it's based on an estimate, right? So you want that estimate to be correct. So right now we're estimating both, really fast earnings growth and continued earnings growth, but also, historic multiple, essentially the S&P is trading at, 22, 23 times forward earnings. This is about where the valuation peaks, in 2022. It got a little higher than that in the dot-com bubble, and the 10-year average is around 16, 17. A lot of people will say, well, the composition of the S&P is much different now than 10 years ago. There's a lot more tech companies. There's a lot more companies with much lower debt, higher margins, et cetera, better companies that deserve higher valuations. Okay, fair. Do they deserve 25% higher valuations, right? Like how many turns higher do they deserve? And again, valuation is not, these things fluctuate over time. So you don't necessarily want to buy at a high valuation, right? So we're certainly seeing that. I think a lot of that is is from the tech stocks. But even if you look at some value stocks, even if you look at some like mid cap or small cap indices and compare that to their historical average, those look expensive too. And then of course, you have kind of this risk taking in the market where if you kind of divide up the stocks in the market that are doing well, you see the stocks that have, profit. If it's not related to AI, but it's still a profitable, high quality companies, those are not doing well. If it's related to AI and it's a low quality company with no profitability or sometimes even no revenue, those are doing very well. Okay, so this is a market environment where you're kind of being punished for not being related to the story, even if the fundamentals backing the trade look good. And so that just tells me that there's a lot of risk taking in the market. There's a lot of people that are willing to kind of bet big on a story. And we've seen this in history, right? We saw this with railroads. We saw this with oil. We saw this with electricity. We saw this with airlines. We saw this with radios. We saw this, I remember, reading a book talking about how the picks and shovels way to invest in the growing auto market in the 20s and 30s was to buy tire companies. Rubber companies, right? You can't have a car without rubber, right? That makes sense. Nope, big bubble, burst, right? And so, but these are still things that we use, right? So I think when I'm in a market like this, it always makes me want to take a step back. My number one rule is, first, do no harm. And so there's the capacity for these kind of markets to draw down quite a bit. And of course, we talked about the slowing economy. We've talked about some of the issues with the debt markets. There's an expectation that the economy is going to surge going into next year related to Fed rate cuts, but also the OB3 bill and the tax revenue or the tax refunds that are going to come in from that. But still, I think it's time to be cautious and understand kind of what you're betting on, right? And what needs to go right for your bet to do well.
Yeah, certainly. No, you made a lot of good points there. I think you did mention kind of a good opportunity within there is maybe some of those profitable non-AI companies, which aren't doing as well because they're not related to AI. I feel like everyone is like, how do I get invested in AI? They'll be investing in companies that are related to AI, but don't really have a plan of making money anytime soon. And those companies are trading at much higher valuations just because of their nature of the business. And
right. It's the concept, right?
Exactly.
Like, you have, we not even talked about like the feasibility of AI and the physical constraints of the power and the energy. And of course, a lot of them are hoping that, nuclear small module reactors will be able to do that kind of this on-site nuclear power station to power the data center. Well, right now, there's 0 of those operating in the US. There's a few in China, but that's about it. Right. And so we've not really demonstrated that yet. Right. How about the transmission lines? Right now, our transmission lines infamously already can barely handle the load that they have to take now and like peak summer months and stuff like that. So how are they going to add on data centers? We need new transmission lines. That requires all kind of permitting and layers of approval. Right. So I think there's reasons to just say, are there ways that this could not work out as expected or not work out as planned? Or are people maybe getting ahead of themselves with this? And again, we see this all the time in periods of new innovation where people rightly see that it's revolutionary technology, very innovative, and going to unlock mass amounts of productivity, but they get way ahead of it on the timing and kind of misidentify who ultimately is going to benefit. And, one thing I like to remind people is if you wanted to make a profitable investment in the 90s on the rise of the internet, some of the best companies to buy right then, excluding Amazon, Google, Meta, right? They didn't exist then. You couldn't have bought them then, right? And so I think people just kind of need to take a step back and consider those things. And to your point, profitable companies that are trading at, discounts to the large cap growth, they're kind of, even though everything in the market's expensive, they're kind of the cheapest area of the market. They have good, solid fundamentals, and there's a lot of, single stock idiosyncratic catalysts within the portfolio for some of the managers that we use that are, separate from the AI discussion that we think have a lot of value, even if the market right now is punishing those names.
Yeah. I know a big buzzword, we've kind of been tapering around, a big buzzword in markets and investing is that word bubble. And it's often thrown around in different scenarios. I guess, how would you define what a bubble is and what is important for investors to know with just bubbles in general? And then do you kind of feel like this might be leading to one within AI?
I mean, I think a bubble is when prices become wildly detached from their underlying intrinsic value. And that usually happens because of euphoric herding, as in one person sees it, the stock goes up, and then everybody else wants to pile into it without understanding what's happening and without really any conscious understanding of the importance of fundamentals and profitability. I do think those conditions are set in the market right now. But there is also a lot of talk about a bubble, and there's a lot of talk about the 90s and the internet bubble and wanting to avoid that. And so I think there's almost an appropriate amount of caution to where you don't think that we're getting ready to burst here. But that doesn't mean you still can't find pockets of people maybe getting way out over their skis. I talked about, SMRs, company like Oklo, which has made a lot of people a lot of money, could very well have revolutionary technology that's in place for 20, 30, 50 years. But right now they have no revenue. They not really delivered any SMR. They have no contracts to deliver an SMR, but it's what is it, $30 billion? Should I look this up? See what the market cap is?
Sure. Yeah.
$24.5 billion company. And you see a lot of stuff with like the rare earth companies right now. I was looking into some of those. A few of them have like a few acres that they have the rights to mine, but they have not started mining. They don't have permission to mine yet. They just have the rights to it. And rare earths, what's interesting? I was looking up rare earths. They are 1,000 times more abundant than platinum in the Earth's crust. So they're not exactly rare, but what they don't have is there's no dense deposits of them. They're just scattered across the entire globe versus, you go see like gold or silver or platinum, you can find deposits of them where it's kind of more dense. And so it's a lot harder to mine it and then refine it into eventually those magnets. And that refining thing is what China is so good at that we don't have here in the US. So it's not even about the materials, it's about the actual chemical process. And so I think a lot of these things, you really got to just take a step back and say, like, for my money, do I want to take a moonshot slam dunk investment in something that's not demonstrated? Or do I want to maybe look at some of the companies that have sold off a little bit, maybe trading a little rich, but so is everything else. But maybe their story is a little more reliable or realistic.
Sure. No, I mean, I think all of that makes sense. Another point I'd want to make, which I feel like I make a lot, is not to necessarily market time. I feel like people will look at what's going on and being like, oh my God, the market's been running so hot for the last 3 years. I need to sell out. Well, that was kind of the same story at the beginning of this year and kind of the beginning of last. And you do that over time, you're bound to miss these long bull market periods. I'd say we can identify these trends and look for different sectors where you want to get exposure. And I think that's a prudent way of investing, but selling all of your investments and going to cash or going to bonds during a certain point in time is a very rash decision, which is hard to do on two fronts. You got to time it right with the sell, and then you got to time it right with the purchase back in, which is often the more difficult point. Because if it feels scary now, it's going to feel scary in the future as well. So Always like to bring it back
That's
to
right.
that point.
You never get a good price when everything looks good.
Yeah.
You just don't. You get a good price when everything looks terrible. And I never have clients coming to me saying, let's increase risk after the market's down 20%. That just doesn't happen. So yeah, I think that's a great point.
For sure. Any other points that you wanted to make about economy, markets, kind of what we're seeing? Anything top of mind?
I think maybe just a little bit about what we expect going forward. So I talked about 2026. We had the OB3 bill that did add to the deficit. And so, we had a $1.9 trillion deficit that is stimulative to the economy. And now that's actually going up going into next year. A lot of people are going to see really big tax refunds. So everybody get ready for that. That's going to be fun. Get your shopping list ready, but that's going to create a lot of demand. That's going to create some growth in the first half of 2026. And I think as we think about the economy, of course, we have, we talked about the 500,000 unemployed people, growth in the in unemployed. And so, you want to see demand for labor come back. But at the same time, we would expect to see a little bit of inflation from some of these policies, right? So we have not only, the fiscal injection from the OB3, but then we also have the Fed that's likely to cut rates. According to their own estimates, they expect to cut rates 2 more times by the end of the year, and then probably a couple more times next year. But depending on the nominations and who gets on the board, Chair Powell is going to be replaced in May. We could see some more dovish members be nominated and maybe interest rate cuts a little lower. Certainly we're seeing gold have a good year. I think, paying attention to a lot of, not just the US, but global central banks and fiscal authorities spending a lot of money. So we would say, you want to make sure you have something in your portfolio to guard against that inflation, kind of that just general debasement of the dollar. Not that we expect hyperinflation or spike in inflation, but just kind of that gradual eroding of purchasing power. And when that happens, what you don't want to own is cash. And what you do want to own is probably, if you're going to own duration or a fixed income, you want to own short duration, and you don't want to be on the long end of the curve as inflation's rising, but you also want to own assets that go up with inflation or that can reprice with inflation. Those assets are typically gold, real estate, and stocks. And so even though things do look expensive, I think when you kind of line it up that way, it does make sense that things are expensive, and you do want to make sure that you maintain your allocations, even though, we've certainly seen volatility pick up, but we've seen that buy the dip mentality as well. And I think part of that is understanding 2026 is going to be a high growth, high inflation, quote unquote, run it hot type year.
Yeah, certainly. No, those are all really good points. And I think a good bow on kind of our topic today, bringing it all back together and looking at what we've seen this year and what we're kind of expecting going forward. But appreciate your time as always. I think I might have to go back and rewatch Wedding Crashers because it's just such a good movie.
No, skip that. And instead, I need you to write 3 more jingles for our next few episodes.
All right. I'll be on it.
Get those creative juices flowing, man. Wedding Crashers, you're not going to get nothing from that. Come on.
There you go. Appreciate you, Jeff.
All right. Have a good one.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov.